Good morning. Welcome to the Rick Helps Real Estate Show. Look at that. I made it again 2 days in a row. Might make a habit of this. Hope everybody's doing well today. Everybody's kind of sitting around waiting for Fed news tomorrow. I think it's going to be a great big nothing burger. I don't see them raising rates. I don't see them lowering rates. I see the central bank coming in like everybody else in the financial and real estate industry saying, we're just going to watch, see what's going on. Everything's a moving target. Our trade deficit spiked because everybody front loaded, worried about tariffs. So they went out and bought their iPhones. And then we find out there's not going to be any tariffs on iPhones. So who knows what the direction of anything is going to be. If you're someone that likes change, this is exciting stuff to watch. I'm one of those weird people that like change. I remember, I'll tell you a quick story here, and I'm going to show you some data. I was in a big sales meeting in Texas, I think it was. And you had to take this test. And this test was determining whether or not you liked change or liked things the way they were. And what you found was and it was a baking company. So the engineers, their score was always very low on the creative end. They don't like change. They want stability. And so it gave you a number. And you had to, after you got your number, you had to line up in the room with the lowest number, people that don't like change, to the highest number, people that do like change. And all the engineers were on the far left side of the room over there. Then there was this big long line, and I was way over there this way. Just like, I think my number is like 85 or something. Everybody else is 6, 5, 10. So anyway, I'm a little nuts that way. So I eat up change. I like it. I like seeing different stuff, even at my ripe old age. And there's a lot of numbers now, and it's kind of, what are we looking at? And this chart here is annual appreciation based on annual price per square foot in our market. And it's fun to go back. I mean, look at 2023, where we just fell off the map here, and now we're digging ourselves out of a hole, but we are coming down again. We're right where we were last year. But let's turn on the Wayback Machine here, and let's go back to the financial crisis. So 2007, things started going south on us, almost right at the same point right here, right? And then 2008, that's when things went kablooey. And we were down annually 28.3%, continued in 2009, even worse, hit a rock bottom of 36.4% minus. Then comes 2010, and things start coming back up. We dug out of the hole, but then we started to turn south a little bit again, and we started the year flat, went down some more. 2012, I'm going to get rid of some of these other lines here, because when you garbage it up, it looks weird. 2012, things started really going, but here's the interesting part. Right about here, even as things had already started to come out of the hole, the industry was being flooded with conversations about shadow inventory. We have all these foreclosures. The banks are holding them. They're about to dump them. And everybody was like, oh man, I know real estate's going up, but watch out, because shadow inventory is going to show up and prices are going to come down. And we kind of create those own fear factors ourselves. Look at this. We're up here at 24.9%. So what was happening was, when the numbers were going and they were turning, they were good, nobody wanted to believe it because it was so bad for so long. Well, this may be good now, but maybe it won't be good going forward, because, we have that shadow inventory. Now, if we go and look at Redfin on what our market shows right now, it's showing that we're up 3.5 year over year. This is just for the Phoenix market, not Chandler, Mesa, Gilbert. Surprising good year. So this is where we're at in 1 year. This one's interesting, and I'm going to try and blow this up so that we can all see it together. And it's by price range, and it shows that there was a major shift in sales between March and April, looking at single family detached home in Greater Phoenix, which is our total market. Look at this price range up to 500,000. It says here was up 11.3% in sales, not price. So March we sold 2,706, in April we sold 3,000. 17. I'm interested to see what that is year over year because April's always busier than March, but 11.3%. Above 500,000 to 1 million, down 1%. Over 1 million, down 11.2%. So we can glean whatever we want out of that data, but it's kind of saying that if the price is better, people are interested. And they're going out and they're knocking on doors right now and taking a look at some of the deals that are out there that maybe they are deals, that they aren't deals, but you get in that 500,000 and below range, it gets pretty brisk. You get below 400,000 and they are lining up in the driveway. This is our monthly average sales price per square foot. And again, a lot of ups and downs in this, and it's kind of hard to tell whether what we're seeing now is a downward trend in the long term, or is it going to go back up again? You go back and look at it historically, and you say, okay, here's a dip here. Here's January, went back down in February. Here's another dip. June, went back down in July. You can't make hiding your hair out of it. And here's March, went back down in May, and then of course we went crazy as we got into the pandemic. Then it come falling off. So this is where we are today. Went $316 a square foot down to $6,000 or $301 a square foot. So for buyers wanting a better price, they're certainly getting some good news there. And people are hoping that trend continues. Now, are we going to go into our natural trend of home appreciation without any of the nonsense? So will that put us right here eventually? Time will tell. And you're not going to see me guess on that because I just don't know. Now, this is a conversation I'd like to have with everybody because this is pre-foreclosures. And I went back 20 years, 2005. And, I get a lot of comments. There's a lot of foreclosures coming. Have you seen the spike? And my answer is no, I haven't seen it. Even when I use my handy dandy magnifying glass, I don't see a spike. I see a slight increase. We're 404, but we've been 300, 200, 319. Then back here, 380, 401, 500. I don't see a huge spike in foreclosures. And so if you're seeing something other than what I see in the Cromford report, please send me the link and let me look at it. The other thing that you heard me reference just a moment ago about shadow inventory. There's a lot of comments, people saying that the FHA is holding some 400,000 homes or 1 million homes that are in pre-foreclosure and they're not releasing them yet. And it was in the Wall Street Journal and I can't find it. I mean, I tried looking at the Wall Street Journal. They wanted to charge me money to read an article. And I thought, well, I'm not that interested, but I can't find it. So if there's something out there talking about this inventory that they're holding, and to be honest with you, I don't know why the Federal Housing Authority would hold foreclosures so they can put them out later. And if they did that, that's the same argument as shadow inventory. Of what benefit would it have for them to hold them back so they can dump them? Because then they'll just lose their shirt. Now, they did try an experiment here. There's an article here, FHA walks back Biden area restrictions on foreclosed property sales. And what they're saying on this is, and I'll just tell you instead of trying to read this thing, they had a restriction that said that if a house went into foreclosure for how long did it have to stay there? There's a 30-day period where investors were not allowed to buy the home so that you, the general public, get an opportunity to buy a foreclosed home. And that would keep investors from gobbling things up, and it would let you have a chance to get a home at hopefully a lower price. Well, it didn't move the needle. They found after looking at all the analysis and everything that it didn't have any impact at all, which is sometimes always true. Sometimes always. You can't put those in the same sentence. We're from the government. We're here to help. So they ended up with unintended consequences. The houses were staying on the market longer because they were keeping this pool of investors away from buying them. And it didn't increase the number of people that weren't investors buying the homes. So A for effort, but it didn't work. Looking at this next chart here, this is our leading indicator that we have here in the Cromford Market Index. And it's not going up, folks. It's sitting there at 76.8. It's pointing to a slow summer. It's pointing to supply and demand favoring the buyer, and it's certainly not up here at 142, which was in 2023. But even this, as you look at this, be careful, because here we were going up, 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 and up, and people were buying here in optimism in 2023. And then the Cromford Market Index started to come back down. We still had some pretty decent price reductions. I mean, the overall average price declined in 2023. So some people got bit when they bought here when the Cromford Market Index was trending up. So as for now, it's trending down. Looks like it's staying that way. And then here's our year over year percent change in list price per square foot. Again, this is showing minus 6.5%. Here's zero right there. So list pricing certainly went up in 2023. A lot of optimism here. This is when rates took their spike, and people started. It was about March, I believe, is when we hit that, and so the iBuyers threw their houses out there, tried to get rid of them. Speaking of iBuyers, I'm going to jump over to this tab real quick. Take a look at this. Open Door, their stock 73.67%. Had a little uptick just a few minutes ago, 73 cents. It's now considered a penny stock. How much longer is it going to hang in there? Will somebody buy them? And the reason I bring them up, I seem like a little obsessed with Open Door, but it was a new concept that was going to change the way people were buying and selling homes. You didn't need an agent. You went there with your phone. You downloaded their app. You put in the you held it up to the door, and you got access, and then Open Door knew who you were based on your phone. You could go in and tour them the house. They said they had technology that said, if you were in there for more than an hour, they would send somebody over to see what's going on, make sure you weren't removing the appliances. They never did. They didn't do any of that. They had motion sensors inside the house. Over time, I saw that technology starting to go away. You could still get in the house, but all of the other sensors and stuff that they had inside the house were gone, and they weren't staging them because they were losing furniture. Open Door wasn't. OfferPad was. They were staging homes and getting in and finding out that the stuff that you could fit in your car was gone. I went into an OfferPad house once, and somebody had gone in and set all the thermostats to 65 degrees. You could hang meat in this house. So I called OfferPad. I go, hey, you might want to come check this house out. So it had unintended consequences, but the puzzling thing is when real estate values were going up, these companies were losing money. They were buying homes. They were paying too much for it. They were too optimistic. They didn't recognize that even though Open Door said that they were using their algorithms to set the price, they weren't. They had people setting the price. So the investors were buying this. They were saying, okay, let's go. This is really great technology. The computer tells us what the home is right. Open Door buys it, puts lipstick on a pig, sends it out, and they make a profit. Well, they didn't make a profit. And then when house prices turned, you can see what happened. Went from $25 to 76 cents right now. So I don't know how it's going to go. Arizona Jeep Adventures, good morning. How are you today? Thanks for watching. Here's our average list price again per square foot. We're down at 2023 levels. Let's see, that's 2023, the purple, and we're lower than 2022. So the average list price is finally, to me, starting to get in line with the average sales price. It will never be at parity. The average list price is never going to be right at the average sales price because it lags. The sales happened 30 to 45 days ago. The list price is today. We're seeing longer times on the market, and we're seeing some movement, but we're not seeing it really hurting us in months of supply yet. We did spike up in January of 5 months supply, and now we're sitting here at 3.4. So as you can see by the ticker below, we still have on a 7-day moving average 3,100 homes going under contract on a weekly basis. It's low, but it's been this low now for, I'm going to say, 3 years. Last year was what we called a crash in transactions. So it's been this low for a long time. And during some holidays, it climbed down to like 2,200. I would expect we're going to see 26 to 2,800 as we go through Memorial Day weekend. You'll see a little bit of a dip in Mother's Day, and then it gets really hard to, you're going to have to dig out of that in a couple of weeks, find out what our summer average is going to be for contracts over a 7-day period, but I'm going to guess and spitball and say, I'll bet it's 3,000. So what we don't know is where our inventory is going to trend and where we're seeing. And so we've got our active listings as I predicted, which was easy because it's easy to predict a week, right? That we would come down a little bit because based on my 7-day moving average, we had a lot of expireds and a lot of canceled. So they came down. I think we're going to kind of remain a little bit flat. I don't see people. There has to be a reason to list. Now, the reasons to list are, job loss, divorce, relocation. A lot of chatter out there that we've got a lot of job loss coming. Hold on, look out, things are going to get bad. Could happen. Maybe it's happening now. The GDP numbers that came out are a little muddy. We're down 1% or 1.3%, but that's because of the increase in imports that we had as everybody's trying to front load the tariffs. Take that out, GDP was actually higher. So, looking at the numbers, that all depends on your category. It all depends on your psyche too. If you really want things to crash, you're going to find some numbers out there that are going to back that up. If you're optimistic that things are going to go like gangbusters, you can probably dig up some numbers and find that as well. You just can't win, especially on YouTube. Be kind. Some of your comments are ending up in the held for review section. And I leave them there for a reason. So if you're not seeing your comment show up in the comment section on YouTube, go back and reread it. There might be a reason. It's not me pulling it off. YouTube has what's called community standards. I put a few things in there that says, I don't want you using this word. Well, one of them is Bitcoins, because you get these traders that come on there. I have learned to make money and make 75% of my money on a weekly basis. Oh, are you using Mary Smith? Yes. And then you get 15 different comments. I get rid of those. So I see Caitlin, she leaves them up. Her and I, we kind of watch our channels quite a bit, and she leaves hers up. Here's send friendly comments. Yes, please do. We're talking about having a couple of pop-ups. That's Pat and I getting out, and we're going to give you notice and go, hey, we're going to be at, here in Gilbert at 5:00 today. Come by and say hi, and we'll buy you a drink or some hors d'oeuvres or something. So expect to see that in a couple of weeks. We'll celebrate the coming of summer and good times to be had. So for me, all of my medical stuff ends in 10 days. So I'm going through radiation, and it's just a 5-minute adventure. I drive down to Gilbert, I land this machine, it spins around me for 5 minutes. See you tomorrow, Rick, and off I go. And that's why this show's on at 7:15 and not at 8:30 now. And it's just a small, it's not life-threatening. I'm not worried about it. They're just getting rid of a couple small tumors that they saw. But I implore you, if you are over 50 and a man, get your doggone PSA checked, because that's how I found mine. So when this whole deal's done, it's party time for me, and I'm going to be done on May 19th. And so you will count on us having a pop-up after that. I got a question here. Good morning. Can you look at Chandler inventory sales trends? Crawford report shows the strongest market. Any reasons versus Gilbert? Chandler is, let's take a look at the inventory in Chandler first, if I can pull that up. For some reason, I increased the zoom on a screen here. And so if I can do analysis by city, and I'll do active listings here weekly, pull up and see what we've got here. And let's see by city. I'm going to pull up Chandler, and right there. So their active listings are 568 versus Gilbert. This really won't tell you anything except for the trend. Gilbert's going up as well. I think one of the things that you're going to want to see is the actual chart that we have on Cromford, which is their CMI chart. It's showing that they're still at 123 and Gilbert is 102.6. Chandler's got, there's a lot of stress in Chandler over Intel right now. They've announced another 20% layoff. So people are kind of on edge there, but yet the market is still performing well. The other thing in Chandler versus Gilbert still has room for new construction. So if you're a resale home in Gilbert, you're kind of up against the big development down the street that's offering 4.9% financing and all kinds of goodies on new construction. Chandler, they're out of room, so you're not going up against new construction. So I think that's what you're seeing. And in these other areas like Maricopa, Buckeye, and Queen Creek, I mean, those are huge examples of what happens to you now competing with new build, especially Maricopa. I mean, 52.8, that's a bear market if you're a resale down there. And Maricopa would be selling like crazy if it wasn't for the fact that there's only 2 lanes to drive down there. It takes forever to get in and out of there. Some nights it's just real smooth. Other times just nothing but red tail lights. Only takes one accident to close the road for a couple hours. So it's kind of rough. They're going to change that. They're negotiating now to expand it, but that's not going to happen in a couple of years. And they're going to build another spur that takes you out to Interstate 10. That'll give you a little relief, but not anytime soon. So, things to watch out for. And I ask you also, have you signed up for my newsletter yet? This is my newsletter, comes out every Monday morning at 8 o'clock. Thank you. 3 of you signed up for it yesterday. And I show you that very same chart every Monday morning that we have in the Cromford Market Index, along with some stats that they provide. I give this to you. This is very easy to read on your phone. It's mobile friendly. And then I get mortgage news here with the rates and then mortgage news. And on the bottom, the ever so valuable My Opinion section. And then, of course, I celebrate that we have 2 million views here on YouTube, thanks to all of you. So sign up for that. I don't spam you. I don't add you to another list. You're not going to get spammed the way I do on a daily basis in my email. Rick, we would like to collaborate with you. We saw you on Instagram. You have great content. And I'm thinking, I took a picture of a lake. I mean, what do you mean I have great content? Enjoying the heck out of it. So anyway, I hope everybody has a great Tuesday. And let's see, anything going on today in the financial markets? No, absolutely nothing. So everybody take on the Tuesday and have a great day. I will see you maybe tomorrow. Take care.